Good afternoon to all our guests today in this webinar, and I welcome you all whether you're watching live. So please make sure you drop a yes or a hello. Just let us know that you are here, and we are going to be discussing a very hot topic about the borrowing capacity for people who want to buy their family home or they want to buy an investment property. And all of us are struggling with borrowing capacities right now. And what can you specifically do before that financial year finishes within this financial term to actually bump up your borrowing capacity? Before we jump into that with our very special guest today, a quick word about myself. So I'm Adeel Rizvi, and I help people create financial freedom and real wealth through property investing without sacrificing their lifestyle. That's all about me for today. But now, before we delve into our very hot topic today, I would like to introduce my very special guest, which is Sakib Manzoor from Secure Financial. Hi, Sakib. How are you?
Not too bad. How are you? Good afternoon, everyone.
I'm very well. Thank you, Sakib. And thank you for joining us. And guys, if you're watching us live now, you can post your questions, feedback, suggestions, because Sakib is kind enough to take your questions as well during today's session. So please put your feedback through, put your suggestions in the comments, whether you're watching it on Facebook, YouTube, or on LinkedIn. And if you're watching a recording later on, please share your feedback and questions later as well. So Sakib, we are into an environment which we call a higher interest rate environment, but essentially that is how the interest rates have been, like 5, 6, 7% historically, right? And you being in the mortgage world and doing loans and writing loans for people, where do you think this is going right now, and what can people do to actually really have their borrowing capacity bumped up? Because it's tax time, people will be doing their taxes very soon, or they already are doing it. So what are your tips for those people?
Okay, sure. Thank you very much for your question. First, just the context with regards to interest rates being high. If someone has bought a property in last 14 to 15 years, for them, yes, the interest rate would be at the highest that they ever seen. But rest assured, we are not even halfway through where they used to be. If you just go back another 5 to 10 years, back in the 90s, the interest rates, they went up to almost 18 to 20% at a certain point. And around GFC time, 2008 to 2010, the interest rates, they were hovering around 8%. So it's only after that, somewhere from 2011-12 onwards, when we started seeing a reduction in the interest rates. And then eventually we saw them at the lowest they had ever been in Australian history for the last 40, 50, 60 years, where the cash rate, the Reserve Bank rate, was as low as 0.1 of 1%. And it stayed there for a good number of years. And only after COVID, where the inflation went up so high, to control the inflation, the only tool that the Reserve Bank of Australia has is to start increasing interest rate, just to curb the purchase power of the consumers, so they stop buying or they reduce buying. So that the interest rate hike cycle started from May 2022, and it kind of peaked towards the end of last year, where the cash rate went all the way up to 4.35%. So if you add the margin from the bank, which is normally at least 1.5 to 2%, on top of the cash rate, you will see now the variable interest rate being around between 6 to 6.5%. So now the way I see it, the way all the economic indicators are, the inflation is pretty much under control. It is at a downward trend, and it's trending really nice to be close to or below 3%, which is the Reserve Bank mandate, to keep an inflation between 2 to 3%, not too far in the future. And that is why, and plus you see all the other indicators that would kind of let economists start forecasting that the interest rate cycle has peaked now, and now the only movement that you see in the interest rate will be the downwards. So reading across different economists, what I see that it should be happening in just a matter of time, but most likely it should be happening sometime this year. So when interest rates drop will happen, yes, I'm now going to go towards the later part of your question, which was the borrowing capacity side. So having a reduced interest rate obviously is one way your borrowing capacity starts freeing up more, because normally the banks, they use a benchmark rate, which is 3% or 2.5 to 3% higher than what the actual rate that they will offer would be. So if
Yep.
the bank is offering you 6% and you add a 3% buffer on top of it, so the rate that they will use to see your affordability to repay the loan will be around 9%. So obviously 9% is as high as it can go, you know. So as soon as the interest rates start dropping, you will see that the benchmark rate, overall rate, they will start coming down. That will free up your borrowing capacity. That's one side. That's one way you will see your borrowing capacity coming down.
Yep.
I mean, obviously, the loan amounts are relatively higher than they used to be a few years ago, and you don't see them coming down anytime soon because people they don't have too much of a disposable income to start paying off a bigger chunk of their loans anytime sooner. So there are other ways, and the first of all, I would say come to and talk to someone like myself, a mortgage broker. This is exactly what we do every day. We know how it works across all different lenders, how they check their borrowing capacity. Where we can maximize your borrowing. There are certain little things that you can do, and we can actually sit down with you, do a proper need analysis, see what your short-term and long-term objectives are based on the objective that you are looking to either upgrade in the future or buy an investment property for that matter. Then we can suggest them some little changes in the lifestyle. They could be possibly one that reduce some spending on the things that they can. That's one could be. Also try to pay off their credit cards, pay off their personal loans, or make sure you don't take any car loans for that matter, because all those loans that you are having, they would make a bigger impact on your borrowing capacity. The last part to that question, yes, you're right. It is a tax time, the end of the financial year happening end of next month. And for a lot of people, especially for self-employed people, I see this being an opportunity in a way where if they come sit with us, we can check with them what type of borrowing capacity they are thereafter to fulfill their future finance need. And again, we can suggest proper, nice legal ways where they are able to increase their borrowing capacity. We're just a phone call away. Please.
Beautiful. Now, thanks very much, Sakib, for a thorough answer. We also go through situations where tax time definitely is one thing. People often reach out to us, and you made a very good point where people are doing their taxations in the next couple of weeks, or they're already doing it now because the financial year is very close. So I think that we're needing to know what expenses they can claim, what incomes they can show will also help them actually maneuver with their borrowing capacity within their legal means. It's not about doing anything illegal or something which is recommended. But I think that's a very good time where people can actually look at their balance sheets and especially people who are self-employed. I get to deal with a lot of people who are making probably $400,000, $300,000 in their business easily, like small businesses. And they can be self-employed with just one person, like one-man band kind of army. But because their taxation is not taken care of properly, that is where they really struggle at the time of when they want to borrow their money for the next property purchase. So I think that's a very good point you have made, especially for self-employed people, all those business coaches, all those people who are giving, especially in the service-based businesses, they really need to have their taxation side sorted so that helps them in their borrowing capacity as well. One question I had specifically for people. Now, I get to deal with people. I actually had a client recently who came to me. They are expecting their second child in 6 months of time. And they're making really good money. And they said, okay, we'll probably have our second child in 6 months from now. It's a big thing for us as a family. And then after we have gone through that process, then we will potentially look at buying our family home 1 year later, which is next year in 2025. So what would be your take on that? Having that additional child, how does that impact the borrowing capacity, especially when the market is really hot right now?
Okay, sure. See, two sides to that. Yes, when you have an additional child, it does have a slight impact on your borrowing capacity. It's not massive. Just an example, just a ballpark figure I can give you is every child, you can add between $300 to $500 worth of monthly cost that a lender would include in your living cost on a monthly basis. So if you have one child, so that's other than husband and wife, let's say if it's $3,500 monthly living expenses, they will add another $500 to it, so make it $4,000. So if you have a second child, they'll make it to $4,500. So it's not a massive impact, but it does have a small impact for sure. The other thing I want to mention in terms of
Can I
people.
ask one question over here? So you mentioned about living expenses for a couple with one child around 3,500, roughly speaking, right? Give or
It
take.
varies with the lenders. It varies with the lenders, but
Yep.
I would say it will be around $4,000. Yes,
Yep. Does that also include the rent they're currently paying in the property they live, or is that separate?
that's separate. So living expenses could be your transportations, your energy, entertainment, food, and all of that.
The
Uh,
groceries.
Groceries, yes. But anything to do with any mortgage repayments of any properties you may have, any investment properties, or uh, any optional expenses like school fees and all of that. So they are all add-ons to that.
Yep.
So and the rent as well. The rent is an add-on. See, but if you are looking to buy a property where you can move in, the bank will not consider your existing rent anyways, because once you move into your own property, you will no longer have to pay a rent for it.
Exactly. Yeah, that's fair enough. So yeah, there. So sorry, I cut you in the middle. Do you want to
No, so
continue?
there is a sort of not a misconception, but a lack of knowledge in terms of some people. They think that once you have a child and the wife is no longer working for a short period of time, that is a big no-no in terms of borrowing capacity, especially if you have both husband and wife earning and now you would only have one, then it wouldn't have a major impact. Luckily, if you are going on a maternity leave, and if you are generally planning to return to the same job within a 12 months period, or in some cases up to 2 years, and you are able to get a letter from your employer saying that yes, you will be joining the same job after an expected date 12 months from now, most major lenders will accept that as your income, which essentially means they will consider that yes, the income that wife is earning in this case, if she is planning to go on maternity leave, will be added to the borrowing capacity. There are a couple of small things they want to see if you've got enough savings to pay for that additional repayments for that 12 months period when you're on leave. But that's about it. If you've got a saving of say $20,000, that will easily cover for that. But other than that, the total borrowing capacity, it does not get impacted greatly, even if someone is planning to go on a maternity leave.
And that's a very valid point, because we get that question every now and then, people getting stressed out that we will have a maternity leave, we will have a break in our earning. Of course, as long as you have the savings to pay that difference of loan,
True.
even though you don't have the income, you can still take the loan with major banks. That's a great.
Exactly. And to be honest, I have even had discussions with people who didn't know about this, and they were discussing with an option that should we delay having a child.
Wow. Okay.
So I said, no, I mean, that's your own decision, but not because of that. As long as you are able to get the letter, yeah, we can still do it, to their amusement. So no, there are options available, and most major banks will accept that as a condition. Nice and easy.
Yeah, and beautiful. I mean, definitely you can help people plan their mortgage and plan their finances. We can help people plan their properties. But one thing we can't plan is for them is their families. So that's something they have to do on their own, isn't it?
That's true. That's very true.
Beautiful. And where do you see this market going from here? I mean, there's a lot of demand still for the property. The property prices are not slowing down in all the major markets across the country, as we have been witnessing for a lot of our mutual clients as well. So from loan point of view, from finance point of view, where do you see this market going from here? Will it just keep rising for at least 12 months more? What are your takes on that?
Whatever I read across different property experts or gurus, I also have a first-hand knowledge. I am an enthusiastic and a sophisticated investor myself. Plus, I get to talk to my clients every day, in dozens, I would say. So, yes, you're right. In most major markets, including the regional markets, prices are increasing. There is a massive demand, and now actually people are not really sitting on the fence. Now they actually are making decisions. If you could talk to me last year, there was still a great demand, but people were not 100% sure should they go for it or not. But now they are making decisions more often than not. So I see property market on the up everywhere you see it, and that is, if you ask me, is one primary reason. I mean, one reason has always been for a great 20, 30 years in Australian property market history is that the supply side has always been a bit lower than what the demand is. So that's always a discrepancy there. So that's one reason. The other big reason I see is the anticipation. Everyone seems to think now the worst is over. This is the highest of the interest rate that they have seen. And now soon the interest rate is going to start easing up. which also eases up not just the borrowing capacity that it frees up, but also it eases the monthly repayments. So it makes it a bit more affordable in terms of making your repayments in the longer term. So that's another reason people are anticipating that better things are coming, and that's definitely a reason that market price, the property market prices are going up. Now, if you sync it with what's happening in the finance market, even the lenders are feeling it. Then they know that the demand is there. I see for last couple of months, they are now slowly and steadily some new offers coming up where the interest rate that they're offering, especially on the variable, they are reducing. As of today, like Kudos today, the Qantas Bank, they just today announced that they have reduced their rates to below 6% now. So we got 3 to 4 lenders in the market. They are all offering variable rate under 6%. And that is just, I think, just the start of the massive the mayhem that I believe is about to begin in next 3 to 6 months, when you will see a lot more lenders reducing their variable rates as well as the fixed rate offerings, maybe offering a good cash rebates. So there's a lot happening, and there is more to happen in the finance market as well.
And having said that, with all those rates potentially starting to come down in the next 3 months, 6 months, or even 9 months, no one can put an exact finger on that time frame. Even RBA cannot do that, but it's imminent. It's somewhere happening in the near future.
It's a highly likely. Yeah. When you look at all the indicators, plus you read all the economists, plus even you read the notes from the RBA, it's more likely for them to come down than actually staying where they are or going up.
Exactly. So with all this environment, if someone is looking to get into the property market, whether they're buying their first home or whether they're looking to buy their first investment or their second investment, should they really wait for another 6 months before the rates come down, or should they actually take an action now? What is your advice on that?
Okay. See, first of all, obviously, come talk to someone like us. Let us check what your borrowing capacity is, which also means that we can check if whatever you are able to borrow, does that mean that you are generally that means that you are able to repay that loan. So that's your affordability to repay. That's what the borrowing capacity is. So we can check what your affordability to repay is, and that if that fits into your budget, into your plans, then the next one is, should we do it now or should we wait? Right? That's the basic question.
Exactly.
One way obviously is that how needy they are. If it's an owner occupier, there's a change happening in the family, or the job related or something else, or they want to have kids going to certain schools. Yes, they don't have choice but to make a move as soon as possible. So, but in cases where they can wait as well, I always ask them one question. I said, what if you think there's a chance for you to buy something for $25,000 or $50,000 less now than you may end up paying for if you were to wait in 6 months' time? Because if the market is going up, as you see, 0.5 to 1% every month, that tells you something, that there is a good case where the property prices could be 10+% higher in next 12 months. So that means on a $1 million loan, there'll be an addition of $100,000. So if you wait for 6 months, that's pretty much $50,000. Exactly. So that's why, while they tick all the other boxes and the prices are on the up, my question to them is, do you want to buy the same property for more? Or if yes, then yeah, possibly you wait for some more time. If not, maybe this is a good time for you to go out and make a decision.
You're perfectly right with that. And once we get that question, we actually also go through their cash flow and scenario and look, okay, what can you easily afford? How much you can pay out of your pocket for that next property purchase? And if that is something which comes down to like $1,000 a month, and you can pay that $1,000 a month, then why are you delaying the decision? Because if you don't make a call right now, that $1,000 a month can soon become $1,400 a month, just because your loan amount will be higher in 6 months. Exactly. Because the prices are going up. So even though you will be able to afford a bigger loan, but why are you taking a bigger loan for the same property which you can get $58,000 cheaper today?
Exactly. So imagine 3 things happen. One is you end up buying probably the same property for more, higher price.
Yep.
That also means that now you have to have more deposit, because deposit is a percentage of the purchase price, right?
Yep.
So now you need to save up more. And third, you end up having higher loan, which means now you need to have your borrowing capacity increase as well at the same time, which may
Exactly.
not happen if the income is same, all the other circumstances are same. I don't think the borrowing capacities they change much if there hasn't been an interest rate decrease in a given 3 to 6 months time. So all the other variables they would also become worse for you if you delay your decision.
And one thing, if you may allow to add over here, the fourth factor, which we are seeing a lot of people, not just like yourself, a lot of people across the country are waiting for that first interest rate dip to come through before they become really active. So what you are doing is, if you just keep waiting for the sake of waiting for the interest rates to go down, thousands of other people are doing exactly the same thing, which
True.
means you will be competing against those extra thousands of people as well. Then you're going to buy that asset, which
I,
means the price
believe, I strongly believe, yes, you are
yes,
right. So then you'll be competing against a lot more people. So which means there will be a lot more demand at that time. Supply side, I don't see we're going to see massive changes, in the 6 months to 12 months time. So which means more people wanting to buy and the lesser properties. That's a recipe for disaster, if you ask me, in terms of, the prices going up for the properties.
exactly.
That's
So
very true.
beautiful. So the best time is to buy now if you can afford it, and whether you can
I
afford
have been, yeah,
that's where you have
that's
to
right.
come and speak to Sakib for loan side of things, and you can come to us as well to see on the property strategy side of things whether that strategy would work for you as well or not.
That's correct. So especially when it comes to investment property, where, as you know, predominantly, yes, people would buy investment property when they have enough equity, as well as the borrowing capacity. Plus, they have this investor risk profile as well. And then once they have done it, they also want to explore their self-managed super funds, because which is another way where you can put your self-managed super fund money towards purchasing an investment property. And in Australia, there is a borrowing allowed within the self-managed super fund space as well, where you can borrow 70 to 80% of the purchase price, and the remaining 20 to 30% can be funded through your self-managed super fund. So that's another area where people definitely can explore. I'm not saying that everyone should do it. That is a very complex a structure which needs to be discussed with your accountant, as well as a financial advisor. If you would like to seek a financial advice, whether you should opt for that and going ahead and setting up a self-managed super fund.
Yep.
My job is, once you have decided that yes, I am going to, or I probably already have set up a self-managed super fund, I can then, as a mortgage broker who specializes in self-managed super fund borrowing, I can check how much they can borrow within their self-managed super fund, and I can explain them all the other things related to that within the self-managed super fund environment. The one good thing with self-managed super fund with regards to borrowing is your normal borrowing is not related to your self-managed super fund borrowing. So let's say if you have maxed out your borrowing outside super fund, where you say you've got an owner occupied one investment property, and with the income and the savings, you cannot borrow any further. You probably can still borrow to purchase a property inside self-managed super fund, because inside borrowing, generally lenders, they look for two things. One is how much yearly contributions that you are receiving in your self-managed super fund, as opposed to your income, and secondly, the potential rental income that investment property will bring. Those two things together will determine how much you can borrow within a self-managed super fund. So that's another way where you can opt for another investment property if you would like to.
Definitely, and that's one of those ways which is highly highly ignored by a lot of people just because of the lack of knowledge. But I think you have touched upon a very good point, Sakib, and I already have plans to actually go through with you on this in a separate webinar in much more detail, because it attracts a lot more questions and we need to address it properly in future. But thanks for bringing it up. I'm sure if people want to explore that, they can reach out to either yourself or to us as well. So before we wrap it up, Sakib, if someone wants to get in touch with you just to understand where they stand with their borrowing or how can they improve their borrowing, what's the easiest way for them to reach out to you?
See, I love to advertise my personal mobile phone. So they don't have to go through the hoops to get to me. So you can reach out through our website, which is securefinance.com.au, or you can call myself. You can search up my name online. You will be able to find my details. You can reach out to me via mobile, via my email, sakib@securefinance.com.au, or my mobile 0404-262-056. And yeah, happy and ready and willing to talk whenever you like. And again, my job is to do a fact find or a need analysis with the client, and the on based on our discussions, then they decide what's the best case course of action for them to take from that point onwards. If that requires me getting a pre-approval for them, by all means, I will be able to get a pre-approval, which is no frills attached. No, we get a pre-approval, which is normally valid for 3 to 6 months, and then they can go about their ways finding a property. And why not to reach out to you, especially for an investment property? That's your forte. That's where your expertise come in, and you have been helping my other clients as well. So thanks for doing that. I had a great feedback from all the clients that I have introduced you to, and
My
keep
pleasure.
doing the good job that you are.
No, thanks very much, Sakib. And I think we continue working with the people together and just educating them as to what they can and cannot do, because a lot of times once they're just thinking in isolation, they just don't know what to do, and they just believe in something and they just follow it for years and years. It
Sure.
just pick up the phone, talk to Sakib or talk to myself, and we can guide you further as to what can really work for you, and you can really go forward and achieve your goals much faster than you actually think you can. So thanks very much, Sakib, for helping
That's
my
great.
as well.
Sure. Well,
And
just one final I want to comment I want to make. I know there is a lot of information available online, and people tend to think that they can find everything, but I guarantee you, the more you read, the more confused you are. You need, yes, for the basic knowledge, you definitely go online and read out, but eventually you should be talking to an expert in the field. If it's looking to buy a property, someone like Adeel, a buyer's agent, looking to check where to go, how much to borrow, and what requirements, talk to a mortgage broker like myself. So we would save your legwork going through all the hoops, reading through thousands of pages, going to multiple banks. All you need to do is come to me, and I can, because that's exactly what I do. I have access to all small and big lenders. We are across all the lending policies of our lenders. So we will save your time, and we will find you the right lender which fits into your finance needs.
beautiful. No, thanks very much for that, Sakib. And we will post the contact details of Sakib in the comments as well after this webinar. So please reach out to him. He's happy to take your questions. And thank you for tuning in, guys. If you're watching a recording, please share your feedback, leave your comments, let us know if you have any questions or if you have any particular feedback and what you would like us to cover in future webinars as well. We really want to know about that. So thank you, Sakib, for your time today. It was a very
You're
productive
welcome.
session. I hope people got value out of it.
Thanks
Thank you
for
for your
having
time.
me, Adeel. Yes, you have a lovely day. Thanks, everyone.
Thank you. Take care.
Have a good day. Bye.
Bye.